The man who made $100 million predicting the 2008 crash spent most of 2026 calling iStock's the next dot-com bubble. Then, on June 26th, Michael Burry went long Microsoft through leap calls with a strike price nearly double where the stock trades today. Wall Street's biggest bear just went bullish on one of the market's most AI-exposed names, and whether this breaks his thesis or proves it is the real story. To understand the scale of the contradiction, look at what Michael Burry spent the first half of 2026 doing. This is an investor whose reputation rests on clinical, math-driven skepticism, cemented when he made $100 million shorting the housing crash in 2008. By May 8, 2026, he was sounding the alarm on a new mania. On his Substack, Burry warned that the market was repeating the final, desperate months of the 1999 dot-com bubble. He backed the claim with 3 brutal metrics. The Shiller-Cape ratio had climbed to 40.1, a level untouched since the year 2000 tech peak. The Buffett indicator, measuring market capitalization to GDP, sat at a massive 229.9%. Meanwhile, the Philadelphia Semiconductor Index was trading 60% above its 200-day moving average. Burry did not just write about a bubble, he actively bet millions against it. He held aggressive, long-dated put options targeting Palantir and Nvidia, including a January 2027 put with a $115 strike on Nvidia. He described these shorts as the most concentrated way to express a bearish view on the artificial intelligence trade. His positioning was clear, public, and highly convicted. So when he suddenly bought Microsoft, it looked like a direct contradiction. He was backing one of the biggest software giants on Earth while holding a massive short position against its key chip suppliers. On June 26, 2026, Burry revealed the exact details of this trade. He did not use a standard quarterly 13F filing. 7 months earlier, on November 10, 2025, Burry deregistered Cyan Asset Management, ending his formal reporting requirements to the SEC. Instead, he posted a disclosure directly to his Substack newsletter, Cassandra Unchained. He announced he had purchased Microsoft December 2028 leap call options with strike prices in the low $700 range. To understand what this means, we have to look at how these instruments work. Leaps, long-term equity anticipation securities, are simply long-dated call options, not actual shares of stock. When you buy a call option, you are paying an upfront fee, called a premium, for the right to buy the stock at a set price before a specific date. If the stock fails to reach that price by the deadline, the option expires completely worthless and you lose every dollar of the premium you paid. It is a high-risk, binary bet. The aggression of Burry's bet lies in the math. When he disclosed the trade, Microsoft was trading at around $353. His strike price sat in the low $700 range. That is an enormous 98% gap. For Burry's options to make money at expiration, the stock has to roughly double in about 2.5 years. Despite the steep climb required, Burry explained his logic directly on his Substack, writing that he believed the $350 level for Microsoft is a good place to buy the stock. He chose leaps because he found the contracts inexpensive relative to his multi-year outlook. Because implied volatility on these long-dated options was relatively low, the entry cost was cheap in absolute terms, estimated at just a fraction of the strike price. This allowed Burry to control a massive amount of upside exposure with limited upfront capital, but this is not a conservative buy and hold value investment. It is a highly aggressive derivative play. If Microsoft stagnates, moves sideways, or even rallies 60% over the next 2.5 years, Burry could still lose his entire investment on these contracts. He is not just betting on growth, he is betting on a rapid, massive re-rating of one of the largest corporations on Earth. To see why Burry made this move, you have to look at how he split his portfolio in 2026. It is a classic long-short strategy, but with a highly specific filter. On one side, he is shorting crowded, overhyped favorites like Nvidia and Palantir, companies priced for absolute perfection. On the other side, his long positions are what he calls mass whale falls. These are highly profitable companies that the market has temporarily abandoned during the massive rotation into AI hardware. He has quietly accumulated beaten down names like Adobe, PayPal, and Lululemon. Microsoft fits this long side pattern perfectly. Over the prior 8 months, the stock had dropped 22%, hitting a 52-week low of $349 the day before his disclosure. But this slide stemmed from market panic over Microsoft's massive $190 billion AI capital spending bill, rather than a failing business model or declining software sales. Wall Street worried that this historic infrastructure build-out, representing a 60% surge from the prior year, would choke near-term margins and compress profitability. For a contrarian like Burry, that panic is the exact opportunity he looks for. Instead of buying into the AI hype, he is purchasing a world-class enterprise software engine that he believes the market has severely overcorrected on due to short-term spending fears. By using long-dated options, he is betting that when the dust settles, the core business will easily absorb those capital costs. The trade fits his larger 2026 pattern instead of contradicting it. While the potential for massive, leveraged gains is high if Microsoft rallies, these long-dated contracts carry a brutal reality. Leaps do not offer the safety of physical shares. If the stock fails to climb past the strike price plus premium by December 2028, the options expire completely worthless, erasing every dollar of Burry's upfront premium. Yet the moment the public caught wind of his positioning, the market reacted instantly. On June 26, 2026, Microsoft shares jumped over 5% to close at $372.97, backed by 3 times the previous day's trading volume as investors scrambled to decode the move. This sudden long bet does not mean Burry has abandoned his bearish stance. Elsewhere, he continues to bet heavily against the artificial intelligence narrative. Take Palantir. Even after the stock dropped over 33% in 2026, Burry only covered half of his short position at $107.15. He kept his remaining put options, keeping his core bearish thesis alive. His positioning highlights a sharp divide on Wall Street. The consensus on Microsoft remains overwhelmingly bullish, with a strong buy rating and an average price target sitting around $562. But contrarians side with Brad Reback at Stifel, who maintains a hold rating with a conservative $400 target. Reback warns that the massive capital spending will choke margins for years and take much longer to generate returns. Burry's trade sits right in the middle of this disagreement. His move does not guarantee success. Instead, it exploits a major market divide, risking a finite premium to capture an outsized reward if the consensus is right, while keeping his protective shorts active if the broader bubble finally pops. Today, as the AI crowd runs hot, Burry is playing the long game on their exhaustion. The question isn't if the bubble bursts, but who survives it. This is not financial advice. Subscribe for more sharp market breakdowns.